Welcome guys, it's the very first mentored Q&A session. Very simply, what this is all about is I'm going to go through terminology, I'm going to go through a principle, I'm going to share a very important trading principle with you. I'm going to explain it to you, I'm then going to try and incorporate it into an example. Now, a few of you have asked a couple of very good questions actually. I'm very glad some of the questions you asked. And I'm going to explain them, and then what we're going to do is we're going to spend 5-10 minutes. Any other questions you want to add and learn and gain from, that's your opportunity. Okay, so this is your chance to interact with your mentors, myself, Alex, and Rich. Obviously, we've created all the courses. We do a lot of the streams, so it's your chance. If there's something you don't understand, something you really just want to get that aha moment, this is your chance. So let's get straight into it. I don't want to waste too much time. We're going to talk about leverage today, okay? The big L word. Now, the wonderful thing about leverage is it's a term that not many people talk about. People are afraid to talk about leverage. Why? Because look at every advert you see on the CNBC, the Bloombergs, these spread bettors. All of them talk about risk of loss being more than your initial capital, and leverage is bad, and if you use leverage effectively, you're effectively risking 20-30% of your account on any given trade. So what's being advertised out there is that leverage is a bad thing. Okay, now yes, in terms of the basic essence of portfolio management and sort of making real returns over time, yes, leverage is a dangerous product, but only if you don't understand leverage. Okay, leverage is equally a very powerful product in a sense that leverage allows you to scale up or to take up more risk when the odds are in your favor. Now, if there's one thing you guys can learn from today, it's ultimately that, us as traders, us as professional traders, what we want to do and what we do is we leverage up at a point in time where the probability or the odds are in our favor. Okay, and that's what it's about. Whenever you look at a trade, it's not about the odds of based on statistical analysis. Okay, people always say to me, how do you work out those odds? Right? It's not a case of I have 10,000 samples of a specific trade setup, and I suddenly say, well, the likelihood of the outcome being favorable is 62.5%. It doesn't work like that. Okay, the outcomes are based on various patterns that we develop over time, based on various intuitive price actions we see on the ladder over a period of time. And it's that intuition, that feeling, that confidence, that trust, all of that together equals a probability of an outcome. Okay, so just bear with me when I use that word probability. It's not in the most technical sense. It's not in the sense of, I've backtested 1,000 sample sets. It doesn't work like that. Okay, that's the game left for the algorithms, the statisticians, and the big macro hedge funds that choose to create these algos. Okay, so leverage in a sense of the word. Now, what I want to talk about in terms of the leverage is obviously the pros. Okay, yes, you can scale up, you can make a lot more money. Yes, you can make better returns over the long run. Okay, the important thing when it comes to leverage is to not just understand the positives about it, is to understand the psychology behind leverage, or the cons. Okay, so when I talk about this, you'll very often, if you spend a lot of time with me, I always ask myself, I put myself in a situation of, if there was something or a situation I hadn't been in before, what would the psychological implications of that be? Okay, let's use an example. So let's say, for instance, in a futures market, I'm used to using a one lot. Okay, now over a period of time and over a number of trade setups and trade strategies, I'm going to get used to my risk being within a specific range. So let's say I'm used to my risk being between -100 and say -200 on average over a given period of time. Okay, now all of a sudden I decide I'm going to leverage up and I'm going to go to a 4 lot. Okay, so I'm taking on 4 times the multiple. Now, instinctively, the minute you have a bad trade, this parameter of 100 to 200 is going to move from 400 to 800. Okay? So straight away you can see the psychological impact of being used to being in that sort of a range of a risk, and now you've moved to almost a complete outlier of a risk, something that makes you feel completely uncomfortable. Right? There's going to be a psychological impact. Now, it's important to understand that psychological impact, because what I found very early in my career was I really battled with increasing the size because I wasn't willing to accept that natural progression in my risk. All right? So if you can understand and accept that by the very nature of taking on more risk, your downside's equally going to have to look a little bit different and feel a bit different, right? by accepting that in the beginning, from up front, you're going to be able to learn to leverage up a lot easier. Okay, remember guys, you have to take the downside with the potential upside. That's how it works. Ultimately, what it comes down to is, regardless of how much size using, how much levering, it all comes back to the same process. Okay, whether you're taking on, let's get an example here. So whether you're taking on, let's say, a breakout trade, okay, whether you're taking that on with a 1 lot or a 4 lot is completely irrelevant, right? There is no change to the process. Why? Because the market will take you on a 1 lot or a 4 lot. There's enough liquidity, again, depending on the market you're trading. Okay, so there's no significant difference in the process to trading a 1 lot or a 4 lot. Right? It's just understanding the psychology behind what it means to actually leverage up. Okay, now, important. A lot of you are going to say, yes, but when is the right time to use leverage, or my account can't necessarily handle the leverage? Yes, that is a fact. Okay, it's something I had to accept. So earlier in my career, let's say I had a £5,000 in my trading account. Okay, and I wanted to now progress to maybe a 5 or a 6 or an 8 lot. Now, of course, yes, I have to accept that I might lose, say, £1,500. Okay, that's a significant amount of my account. All right, so what we would typically do as traders, and again, what I want you to take away from today is I want to encourage you guys to learn a little bit about leverage through understanding it. Okay, now one of the things we used to do a lot was when we struggled to get our clip up, we would say to ourselves, okay, if I have a good day, so let's say I make €1,000 today, whatever, and my account goes to 6,000, then I'm going to move my clip up, or I'm going to leverage up by a marginal amount. So I'm going to go from trading, say, a 5 lot to a 6 lot that day. And then if I had another green day, say to 6,400, I would then say, okay, I'm going to push it to a 7 lot. And slowly but surely, I got used to the fact that, psychologically I was taking on more risk. Okay, but I was doing it, I was doing it in a positive run. Okay, the biggest mistake new traders make, I made, most traders make when it comes to leverage, is they tend to use leverage when they're wrong, when they're offside, when they've lost control of a trade. And that's why that psychological damage sits with them for the rest of their careers, because they always seem to associate that blowout in their account, or that blowout moment, to leverage. Okay, it's got nothing to do with that. Right? It was the wrong use of leverage that created it. Okay, so if you've had that moment, if you've had that experience, try and associate. Learn to use leverage when you're on a good run, and do it incrementally. You take those 2 tips of advice, guys, and you're going to finally start, understanding the use of leverage. Okay, so let's come back to that old question, and this is where we're going to wrap up on leverage. Where do professional traders use leverage? Okay, well, it's very simple. Let's say we take, for example, a lot of you guys follow us on the morning streams, and we can talk about, we're going to talk 2 examples. Okay, now let's take the Bund example for this morning. Right? Someone asked about the Bund. The question was there. What was it that gave us the inclination that the Bund was going to go lower? Okay, well, there just happened to be a wedge. Now, I'm actually going to get that up for you so that we can actually just look at it together. All right, so there's the wedge. You can see it nice and pretty on your screens. We've been sort of sitting in this wedge for the last couple of days, almost a week now. And okay, we can see that all of a sudden this morning, we came and we tested that wedge outside of the cash house. Okay, so now we have a trade set up. We have an opportunity. The market is showing us a technical pattern, and we would like to take advantage of this pattern. Now that in its own, and now I want you guys to I want to almost bring you inside my mind, okay? That in its own does not necessarily imply I'm going to use leverage, okay? So what happened in this situation was the market broke, it filtered down, we got a very big pickup in the volume. Okay, so where would we use leverage in this example, all right? Some traders, and what I'm going to need to do now is I'm going to need to zoom you in onto an even shorter term time frame. So I'm just going to bring up the, oh, I don't have it here. Okay, I was hoping to bring up the 1 minute chart. But if you go back and you look at this, okay, once we took out that initial balance low, so I'm going to draw it over here. Once we took out the initial balance low, right, after the cash opened, the market then sat for almost 20 minutes churning sideways. Okay, and within that churn, within that sideways trade, once we had broken down below the key base trend line or support line or whatever you want to call it, once we'd broken below that and started to accumulate, that is when traders employed their leverage. That is when traders got involved. Why? And this is the clue. The art to leverage, guys, the art to trading is knowing the risk. Okay, the minute you know the risk on any trade, it doesn't matter what you want to call it, the minute you know that risk, you have got a very powerful trade. Okay, so the risk in this trade is very simple. Right above that initial balance low, which coincided with that break of that support. That is where the trade was invalid. That is where the trade was gone and no longer worth being in. So as long as we were below the break and accumulating sideways, traders were then leveraging up, getting stuck in that sideways range, and once it then finally took out the bottom end of that downward range, we got the aggressive 10, 15 tick down move. That was the play from this morning. That was how we incorporated leverage. Okay, now let's say for all intents and purposes, let's say it didn't go down in the manner that it did. So let's say it did this instead. Let's say it broke, had maybe a 2-tick pullback, and then broke again very aggressively. Okay, it's very, very unlikely that many traders would have employed leverage. Why? Because when you employ leverage, one, you are taking on more risk. Okay, so you need more confidence, you need more understanding of the trade you're going to take on. Okay, so when there are less variables to lean on, when there's less information to lean on, when there's less probability of an outcome occurring, that is when you don't want as much leverage. Okay, it comes back to that whole question of when do we use leverage? Well, it's simple. When we have good understanding, we know the risk, we're confident, we trust what we're doing, and we want to get aggressive because the probability of an outcome is high. That is leverage, guys, used in an example. Okay, now that's our Bund example for this morning. I hope you guys understood now, not just how we got into it, okay, why we got into it, how we would have executed, where the stop was, where the target was. Okay, again, that's a very personal thing. I never talk about targets because, what is the point about talking about a target? One person might feel that, he wants to take 5 ticks because, he knows there's a 90% chance of that happening. Some trader might prefer to have a smaller size and run it for a bigger target, okay? Targets is a personal thing based on preference. What isn't a personal thing is, one, why we enter, and two, where the risk is. Okay, the risk is known. The minute you know the risk in a trade, you've got to trade. Now, the last thing I'm going to say with leverage. I know a lot of you come from a retail background. Okay, now I never like to insult a retail background. Okay, but I like to just give the facts. Be honest with you guys. Right now, how a retail background would typically work is you would have a candle, for instance. Something like that, and you would then get, the textbook would say you buy through the break there and you put the stop down there. Now, that type of strategy, swing strategy, whatever you want to call it, that sort of a type strategy is not going to work well with leverage. Why? Because, well, hang on a sec. Who can take a 40, 50, 60, tick stop? Right? Not many people. Hedge funds, yes. Big macro funds, yes. They can take very wide stops. Day traders, retail traders with smaller accounts, we cannot take those kinds of stops. And more importantly, we shouldn't need to take those kind of stops. Okay? So make sure when you're developing your strategy, develop your strategy based on, ultimately what your count is. Do you want to use leverage? Do you not want to use leverage? Okay, make sure you're not just picking up on certain things of Twitter and books and suddenly trying to employ them when you don't necessarily understand the full implications of it. Okay guys, I hope you've got an understanding of leverage there. What we're going to do now, I'm going to go through another one of the questions that was asked this morning, and it was all about the oil. Okay, it was Pradeep, thanks for the question, and I know you gave some feedback, by the way. Awesome, love that, love the feedback, guys. Remember, the Axia community is there for you. Okay, yes, of course Axia is a business, of course it is, but ultimately we didn't create this to make money. We created this because we can see the impact of having a trading community. Right? We can see the impact or how desperate the market is for an educational portal from real traders. Okay, so I can see you guys doing a lot of questions. Let's just go now through the oil that Pradeep asked, and I want to just dispel a few truths. Okay, again, like I said to you guys, I like to be honest with you, and I prefer it that way. So what you've got in front of you is the oil. Okay, now a lot of people say to me, yeah, you can't trade the oil numbers because it's too volatile. Well, I'm going to tell you that's absolute bullshit. okay? Because volatility, guys, and you should all know this, you've been following me for long enough, volatility equals opportunity. Why? Well, because what's the very nature of volatility, okay? Let's take, for example, we go to a farmer's market, and we're all at a farmer's market, and suddenly Mr. Farmer goes and says, all right, guys, we're selling mangoes. They were £2 a mango, and now we're selling them for £1 a mango. Okay, 50% drop. What is going to happen to the business? What is going to happen to the activity when prices get dropped from 2 to 1? Well, it's very simple, okay? We're going to see a pickup in business. Why? Because obviously we've seen price shift, right? It's that shift in prices, that dynamic of a shift in price that brings players into the market. Okay, so when players come into the market, it doesn't matter what they are. They can be algorithms, they can be short-term players, they can be people stopping out, they can be any number of players. But when those players enter, that is the opportunity for us to engage, not back off. We don't back away from volatility, we engage with the volatility. Okay, so oil, let's talk about it. I think it was minus 3 million. Don't quote me on this, I'm not even sure. It's somewhere around there, okay? We're expected to come in -3 draw, all right? The number came in +4 build, okay? So in basic terms, what this says is a minus means that we're drawing down on supplies every week. A plus says we're building on those supplies, okay? Now, it came in completely against the expectation. Oil very quickly dropped $1.50, looked very aggressive, very panicky, and very dangerous. Okay, now, what I will tell you is that what most traders did here was we got short. Why? Because simply we have an outlier. Now, it's like me saying to you, let's say the Bank of New Zealand has a meeting, a lot of you trade currencies, and it's expected for the Bank of New Zealand to hike rates. Okay, it's 90% priced in. Now, let's say the Bank of New Zealand comes out and they say, no hike. Guess what's going to happen? Well, the market needs to reprice because there's an expectation. It's the same with oil, okay? So there was an expectation for a draw, it came out of build. So the first piece of information is a repricing. Now, I'm not going to stand here and say that, you know, us traders ran this at $1.50. It doesn't work like that, okay? Maybe 20, 30, 40 prices. Why? Because having watched enough of the oil numbers, you will know that when you have an outlier like that, roughly, an estimation, a rough guess is that you're going to get about 40 or 50 cents, okay? Half a dollar. So most traders got out somewhere over here when we saw the buying enter. Then what we started to do was we actually started to fade the market a little bit lower down. So we actually turned to buyers. Why? Not because there was a level there, not because, you know, we thought maybe oil was oversold. We bought it because we saw some buy side entering the market, right? Yes, of course, based on previous historical trading of this number, we know that, you know, a $1.50 move on a number like that is really big. Okay, so there's an opportunity that exists, but note what I said in the beginning. You always have to manage risk, okay? So the minute we entered long, guess where the stop goes? Right in below that low. And guess what happened? Most traders probably got stopped down and went lower. Okay, net result. Maybe you made some on the short and lost it on the bid. You finished zero. Had the market not continued lower in an aggressive manner, you would have made on the short and made some on the long. 2 trade opportunities, 1 data piece. Note then, obviously, the market then entered a sideways range. Now, why I wanted to include that was very simple, okay? Your question was about volatility and being afraid to trade it. That's fine, okay? I'm not encouraging people necessarily to trade volatility. And with the whole leverage concept, by the way, what you would typically do when there's volatility is you reduce the leverage. Why? Because the market's having bigger swings, so you don't need as much leverage. Okay, so back to the question. If you don't like the volatility, it does not mean an opportunity doesn't exist, right? And we can see that in the 1-minute chart. Notice what the market did once it found a low. Up, down, up, down, up, down, up, down. How many swings do we have there? Call it 1, 2, 3, 4, 5, 6, 7, 8. There's about 12 different swings there where the market sat in a very tight range going up, down, up, down, up, down. Okay, that up, down, guys, there is a strategy in that. Why? Because we know as traders, there is a fundamental pattern. If I get rid of this chart, I'll show it to you. Okay, very often what you see in the markets is that when you have a fundamental shift or a really big trending move in the market, once it's done the trend, it then just tries to consolidate. Okay, and the high probability trade after a trend move is to sit there and try and sell into any weak bounces. So again, Davdeep, to answer your question, it's not always about the volatility. It's about the opportunity. It's about assessing the opportunity based on what is the market actually showing you. Okay. So that covers the first two questions. I think we spoke about the Bund. Okay, the next question I really liked. I want to go up to this one. This is a pretty awesome question. Where is this question? Let's find it. Okay, it was all about how we enter and how we execute. Okay, the question was about, do we get in and fade the market, or do we wait for the market to trade the price and then execute? It depends. I know that's a horrible answer, but it does depend. Okay, so let's say, for instance, the Bund's coming to the 200-day moving average. Okay, and I've been waiting for this trade for 6 months. We haven't traded the 200-day moving average in 6 months. The market comes in a very aggressive manner, so almost like a trend-like manner comes into that price point. Okay, in this example, I'm not going to be passive. In other words, I'm not going to wait for the market to trade it and then reverse. All right, I'm going to leave a limit order and sell as soon as it trades the price. I'm going to fade the market. Why? Well, it's very simple. The precondition going into the trade setup defines ultimately how you want to execute. Okay, so if the market comes very aggressively into this move, all right, and we've done, let's say, an above average range for the day, by that very nature, shorter term time players, once they've overreacted into a very key price point, what are they going to do? They're going to start taking profit. Okay, and it's that aggressive nature of profit taking that implies I would rather be in aggressively. Why? Because I don't want to wait and then take on risk lower down. Okay, so let's take, for example, let's say I did sell that price rather than wait and sell that price. Okay, you can see the difference in terms of your risk. Your stop is still the same, but ultimately your reward in this option is a lot higher than in this option. Okay, your target's still the same, but the risk is different. Right? So whenever you want to determine how you enter, whether it's aggressive or passive, always determine what is the element of risk. Okay? Now, if, for example, we were taking on a different trade, let's say we were approaching a really key area in terms of trade location. So let's talk about a nice zonal area. So the market's been in a nice zone, and let's say we started approaching this area again. Now in this example, given that we've traded once, twice, 3 times, 4 times, 5 times, that we've been trading in this sideways range for such a long time, in this example, I might choose to be a little bit more cautious and rather wait. Let the market do something, let the market show me a little bit of structure, and then I get involved. In other words, what I do is I allow the market to give me more information so that I can then execute. Okay? But remember, as a rule of thumb, the more information the market gives you, the less reward you are going to get. Why? Because more information means more participants are getting more time to take on the same trade idea as you. Okay. I hope that answers your question. That is simply what it boils down to. It depends, okay? It depends on where the risk is. It depends on what you're trying to achieve. One more example to answer your question, okay? So this is a breakout. We've been stuck in this range for a long time. And all of a sudden, we have some fundamentals out today, and there's a high probability we're going to take this trade out. Now, in this example, I don't want to buy it up here. Okay, I want to be pyramiding up there. So in this example, I'm going to be a little more preemptive. I'm going to take risk early so that I can potentially pyramid and get more reward. Okay, but note, preempting is dangerous, guys. I never recommend preempting unless there is a high probability or a very certain structure I can lean on. Okay, preempting is a mugs game. Calling a head and shoulders or a double top is an absolute mugs game. Look at the Bund this week. We had a double top. Guess what we did? We took it out. Okay, yes, we lowered today, but we took the double top out. All right, so don't preempt. All right, there's a time and a place to preempt, but only when the structure is there. Okay, so in this example, yes, I would preempt. I'd get long. The momentum's there. The data pieces come out. I can see the flows in the market. I get long there. I get aggressive. And once we break through on any kind of pullbacks, I'm then looking to add. Okay, different example, different pre-context. But ultimately, the execution is slightly different. So it depends. That's the answer. Okay, let's take some questions, guys. We've got 5 minutes, then we can call it a wrap. So let's get some questions in here. Can you see any questions there, Johnny? Okay, Roger. Hey guys, stream will start shortly. Stay tuned. Right, guys, if you've got any questions, I can't see. There we go. Okay, reference leverage. So when on a side and initiative price action, give trade signal and have a set 1% risk cap for each trade on full clip, do you look to increase risk threshold to say 2 to 3% when probabilities build in favor from your own signals such as, yes, 100%. Okay, same concept. So again, let's take the S&P. Again, I think, yeah, we got asked a question from Pradeep about the S&P. So let's get that chart up actually, and we can talk about this exact question you've asked. So let's get this up here quickly, and there's the spoo. Okay, so to answer your question, it's very simple. The E-mini S&P is this wonderful one in the orange, and in the green we've got the yen. Now the reason I actually put the yen up there is very simple. You often hear on CNBC Bloomberg about correlations and how the yen is up 1% and therefore that's risk off. Okay. Learn this lesson today. A correlation only works when it exists. Okay? Now correlations come and go. But it's your job as a trader to know when those correlations are strong and know where they're weak. Example in mind. Look at the pound versus the FTSE. Go back to Friday last week and Monday, Tuesday this week. There's a relatively stronger correlation between the pound and the FTSE now. Right? Why? Because obviously the UK election. So as the pound strengthens, we tend to see the FTSE underperform. Not necessarily sell off, underperform. Okay? So in that environment, you need to understand the correlation. So the first thing when looking at the E-minis is I need to understand the environment we're in. Now, we can see that the US dollar JPY at the moment has been selling off. What's the yen been, SPOO's been doing? Rallying. Okay. Now, as a rule of thumb, when it comes to correlations, if you want to learn a very good strategy, listen carefully, okay? Only when there's a strong correlation and a technical move should you trade the correlated market aggressively. What do I mean by that? Look at this example here, where we had the 2 days of very aggressive sell-off in the dollar against the yen. What did we see in the S&Ps? Okay, we saw a very aggressive sell-off as well. Okay, so the correlation up to that point was not very strong. Okay, why? Because you can see that. Look at this. So we can see that for the couple of days preceding, there was very little correlation, and all of a sudden, we saw a very aggressive surge in the yen. We saw a rally in the yen, and at the same time, we had a little bit of a corrective play of 40, 45 handles in the E-mini S&P. Okay, so that's the first thing to note. Now, the second thing to note is with regards to your question. Okay, so we can see the E-mini S&P has been in a sideways range pretty much all year, being bought up off of the lows. We then scaled that 2400. Okay, we broke out and we scaled. Now note, okay, when we did break out of that 2400, note the close there. I want to just zoom in on this candle. So there was our aggressive candle. We then gapped the next day. So we had the candle, we gapped the next day, and then we had the green candle. Okay, now, if this was a traditional breakout, in other words, if equities weren't at record highs now, and this was a healthy trend, okay, I would say to you, yes. If you preempted the break and you were long pre the break, then you want to be pyramiding once the break is confirmed and the structure is in place. What I mean by that structure, okay, is very simple. When you get a break of a very key level, right, so let's say this is the break. What you do not want to see is a retest of that level. Why? Because if it's a key break, if this is a big trending move, why on earth should buyers be allowed to enter at the picture perfect price? Okay, by the very nature of trend and momentum, buyers should be forced to buy it higher. That is what creates the trend. All right, so the fact that we left a low volume area there, as you can see, or a gap, an untraded area between those 2 days, that was a very strong signal that the trend was potentially healthy. Right? So yes, in that instance, I would have been looking to buy and add to that position. Why? Because you're adding to a winning position. Right? That's the time to add. That's the time to leverage, is when you're adding to a winning position, not when you're adding to a losing position. Okay? Ultimately, yes, note, we had 2 days of inside. Right? So what you could have done, and this is the crucial part to your question, okay? What you could have and should have done is that when you pyramid, when you add on to a trade, it is a separate trade. Know what I'm saying? In other words, if your original trade was here and your stop was here, that's the original trade. If your second trade was to add up here, it has to have its own stop. It's a separate trade. A pyramid are two separate trades. They have their own area of invalidation. Okay, so remember that as a little trick. Always treat a pyramid as its own trade. Okay, yes, ultimately the gap filled, and guess where the S&P is higher. All right, now, to answer your question about what I think about the S&P, well, it's very simple, guys. 2,400, that's the point. Note, we can't get back below that right now. Right? It is a very key point, not because I say so, but because we were stuck below it for almost, what? Since February, guys. So February, April we tried again, May we tried again, and then eventually in June, we broke it. Okay, so it's a 6-month high. It hasn't been tested. Well, it's been tested and it very quickly got bought up. So if it tests again and can't hold above it anymore, well then we should come back into this range and offer a little bit lower. Okay, so that's what I think technically about the E-mini S&P. At the moment, you can see, just look at that, guys. If ever you want to know, people ask, how do I know which are the 10 markets to trade? Well, it's very simple. If I look at that, I say there's no ways I want to trade that. Okay, why? Because 1, there's no trend. 2, there's tails on both sides. Okay, the minute you've got tails on both sides and lots of dojis, it's telling you there's a lot of chopping and changing and positioning. A lot of people being stopped out, a lot of people losing money. Okay, let's take one more question and then we're going to wrap it up. Okay, reference leverage. Okay, we don't even have any more questions. Okay, cool, guys. Let's wrap it up there. What I'm going to say to you is I want these sessions to be short, sharp, and sweet. Why? Because I want you guys to learn something simple so that you can apply it. All I want you to think for the rest of today, for the rest of the week, is about leverage. Okay, I want you to write down, what does leverage mean to me? What do I know about leverage? Do I employ leverage? How do I employ leverage? Where do I employ leverage? How can I be better at employing leverage? That is the whole point of this session. It's for me to mentor you based on the mistakes I've made, the good things I do, the bad things I do. It's for me to relay that experience to you so that you can ultimately be that little bit better, that little bit quicker. But you have to work at it, guys, okay? I can write down all sorts of pretty things. I can show you all sorts of great things. I can give you my opinion, but that doesn't matter. That's not going to make you money, okay? It will make me money, but it's not going to make you money. So take these sessions, learn from them, come back with the questions, engage with us as your mentors and learn what you can. Ask those questions. So many people ask me on LinkedIn, can you mentor me? Okay, I'd love to mentor everyone, but I can't. I don't physically have the time. I'm a trader, right? So use these sessions as that mentor. What can I ask my mentor? Because I ultimately want to learn. All right, hope you enjoyed the session, guys. Give your feedback. Remember, we are for you. We want these sessions to be about you. Good luck for the rest of the afternoon, and we'll catch up again soon.